So if the whisper price is, for example, $10 million on a deal and our back of the envelope price is coming at 30% below that, the bid-ask spread is 30% and it doesn't really make sense.
Welcome, everyone, to our Hero Capital show. I'm your host, Tim Mai, and today I have another amazing guest on the line with us, a Canadian. We don't get too many Canadians on this show, so we're excited to always have one. And Mr. August Biniaz. And actually, I went as I researched learning how to pronounce your name there, August. Are you Persian?
I am, yes.
Very cool. Awesome. It's always cool when I do the research on names that I'm not 100% sure on how to pronounce and to get to learn the origin background of that. It's very cool. And yeah, so August is the co-founder and chief investment officer of CPI Capital, where he leads investment strategy, acquisitions, asset management, with over 15 years of experience in real estate and has been involved in closing over $225 million in multifamily assets. August is also the host of Real Estate Investing Demystified podcast and is a recognized voice in educating both retail and institutional investors. And and August does both multifamily and builder rents. And so with that, August, welcome to our call. Thank you so much for being on with us today.
Of course, thanks for having me. Looking forward to this.
Yeah. Let's start out with, if you can share with us a little bit about you. How did you get started in this world of real estate?
Yeah, no, absolutely. I've always been involved in real estate in my career. I started out as a real estate agent many years ago. I pivoted very quickly to more on the fix and flips and more involved on the active side of real estate investing rather than being a broker. I felt that my skills were better on that side. So I started doing small fix and flips, eventually started my own general contracting firm. And I was focused on building single family homes, both spec and custom homes. Spec is when you build something, put it on the market and try to sell it for profit. And custom is when you build homes for clients who hire you as a builder. So I was doing both of those. Always wanted to scale, wanted to do bigger projects. And a deal came across my desk, which was a townhouse development project. And somebody had purchased it, put it under contract, but they put in a big deposit, but they couldn't close that to come to some financial hard time. The deal was a great deal. That bought it for a great price. They just couldn't close, and another deposit was due in a few months. So they brought this deal to me, and I jumped on it and took over the deal. And without having the money to close on the deal, it was a $8.7 million purchase price. And there was at least $5 million of equity needed. So I went to friends and associates, was able to bring that money onto the deal, and we structured it as a joint venture. I didn't know what
Nice.
syndications were or what funds were, what private equity was. We'll put that deal together. And that was really the start of me coming into this space, trying to learn more. But most of the information when you're trying to learn was coming from the US. In Canada, the syndication and the fund model, it exists, but it's not as common when there's mastermind and there's so much information that exists. So when I was learning a lot of information about syndicating deals and raising money and putting deals together, I found out about multifamily value add, which is a business model that actually doesn't really work here in Canada because in most provinces there is strict rent control. So the value add business model where you let the leases expire and you bring in a new tenant for higher rent after you renovate doesn't really work because you're not allowed to do that here in
Mm,
Canada. So I looked at allowing Canadian investors to have exposure to US real estate, particularly multifamily value add. And that was really the spawn of starting CPI with a couple of great partners.
that's amazing. Wow. Okay. I didn't know that Canada has so much rent control. That's interesting. So let's jump right in talking about what are the differences between capital raise, just touch on in terms of the laws, the SEC laws around capital raising in Canada versus the US. And then I would love to hear more on how do you go about bringing money from Canada? What's that process like into US investments?
Of course, just quickly on the last point, in the provinces that are rent control, most provinces have rent control. Province of Alberta doesn't have rent control. But even in the provinces that there is rent control, unlike California or other states that do have rent control in the US, the rent increase doesn't go by the number of inflation, doesn't go by the same metric, is actually capped at 1.5%. So it's very difficult for investors to want to scale, and that creates dilapidated properties, and investors are not putting money back into properties. Rent control causes a lot of issues long term. But yeah, going back to your question about the regulatory framework in Canada and the US as far as how it's overseen. Yeah, similar to the US, we have our own version of the SEC, which is Securities Commission, it's Provincial Securities Commission. So every province has their own commission, and we have to adhere by their rules and regulations. There are exemptions that are used for investors to be able to raise capital for their deals. And the logic there is, hey, you have a great business idea, maybe you think it's great, but anyways, you have a business idea and you want to go out there and raise money for, the regulators tell you that you have to go through an IPO, you have to go through an initial public offering, you have to draft a prospectus and take this through the standard routes that exist for raising money. But us real estate investors, we go back to the regulators and we're like, hey, listen, we're buying a multifamily property. I have a 60-day close. I have to do everything within this short amount of time. I can't go through the prospectus route and spend $500,000 and go through an IPO. I need money fast. They're like, fine, if you want to do that, then you can use these exemptions that exist to go and raise money off the stock market, off the public markets. So similar to the US where there is Reg D, Reg A, 506C, 506B, there are exemptions we can use in Canada to raise money. One of the simplest exemptions is called the private issuer exemption, which allows you to raise money from your friends, family, and any accredited investor. It just caps you at 50 investors. So you can't raise more than money for more than 50 investors. So it's very similar to your 506B, but you're allowed to advertise. So it gets misconstrued sometimes. There's an exemption which is called the offering memorandum exemption, which is similar to a PPM. So you draft this lengthy document. You can raise from accredited and non-accredited. And it gives you really autonomy when you draft an offering memorandum. But offering memorandum is costly and cumbersome to draft, but you have to update them every year. There's also a function of doing audited financials on the structure, the vehicle you create, which could be costly as well, particularly with cross-border. So there are these multiple exemptions that are available to use for syndicators or fund managers who wish to put deals together. And your next question, I believe, was about how to structure a deal, bringing Canadian investors to the US, I believe.
Yes, but I have a follow-up question in just what you said, and then it will lead us into that next question. So when you're raising capital for US property and you're raising it from Canadian investors, does the SEC rules and regulations there apply to even though it's a US asset?
It absolutely does. Yeah. So if the investment is in the US and you have US offering documents which you filed. So let's hypothetically say we're using the 506C exemption in the US, which allows you to advertise and market, but you can only bring on accredited investors to your deals. But now you have this Canadian investment vehicle, let's call it a Canadian feeder fund that you've created, a project-specific Canadian feeder fund that you're looking to raise money from your Canadian investors, and that feeder fund is going to invest into your US investment vehicle. Of course, all of your Canadian investors have to also be accredited, or the fund itself has to be recognized as an accredited vehicle investing into the US master fund. So yes, you have to adhere by US laws and regulations.
Gotcha. Okay, so then leads us to the next question. So when you're raising for a US asset, you create a feeder fund there in Canada and raise money through that, or do you create your fund here in the Okay.
Yeah, so you create a US master fund, and that's just your US vehicle, so LLC, a limited partnership. However you're structuring your deal, a corporation, a C corp. However, you have to understand that certain entities in the US are not tax efficient for Canadian investors. For example, if the deal is structured in a LLC or a corporation, that vehicle is not tax efficient for Canadian investors because any taxes paid on the US side are not going to be recognized by CRA, Canada Revenue Agency. So the deal has to be structured in a limited partnership, which is the very common ways. LLCs have become sexy in recent days, but larger funds like Blackstone, when Blackstone puts together a fund, they never use LLC. It's always a limited partnership. Limited partnership is the best mechanism to use, but for whatever reason, people like to use LLCs. We don't even have LLCs in Canada. So we have either a corporation or limited partnership. So the US fund is structured in a limited partnership. And then if your audience understands feeder funds, basically the Canadian fund, again, project-specific fund. And the term fund and syndication sometimes get There's a crossover there, a misconception, but any entity that raises money is called a fund. So you have a college fund, for example. So you could have a project specific fund that you're syndicating your deal into, but it's still called a fund. So you have your Canadian feeder fund, which is also a Canadian limited partnership. Your investors are investing into that following the exemption that exists in Canada. So let's hypothetically say you raise $1 million from 10 investors in Canada using one of the exemptions that exist. Let's say all of your investors are accredited in Canada. And now you have this $1 million there. And then your US master fund, you've raised $1 million from US investors, $100,000 from each. So you have $1 million sitting in the US. Your Canadian feeder fund invests into the US master fund and becomes an investor. You should try to make sure that there is no dilution provisions so that your Canadian investors are not getting diluted because there's costs associated with a Canadian feeder fund. So you just got to make sure those mechanics and yeah, your Canadian investor, who is this Canadian fund, it gets his own K1 and goes through the process just as if you're dealing with this one investor. On the investor relations side of it, and then on the tax side of it, there is complexities that exist. One of the initial difficulties that we had was that our Canadian investors didn't want to deal with the IRS and have to file US taxes because they already had enough headache dealing with the CRA. So we got our legal and tax team to allow us to create a structure where it relieves the Canadian investors from having to file US taxes. And the way that works is that the fund itself files for taxes on behalf of the investors. So individual investors don't have to pay taxes to the IRS. The fund has already paid those taxes on their behalf. They get their net proceeds. They go to their accountant and it said, these are the taxes that we paid on our behalf. The fund paid. Please recognize these and tax me less.
Gotcha. Okay. And then is there, so when the investment is made from the Canadian fund into the US fund, that's considered as a foreign investor. And so do you have to hold back money for like taxes and things like that here in the US?
Oh, sorry. I muted myself to cough, but then I couldn't unmute myself.
Oh, gotcha.
Yeah, so definitely as a foreign investor, there is withholding tax. So there's a state and federal withholding tax that takes place. So when the partnership is paying taxes, so the Canadian feeder fund, the US master fund, so let's say that go on the example that I made. So the Canadian feeder fund invests $1 million into the US master fund. The deal does well. After 5 years, the investors doubled their money. Now that $1 million of proceeds, there's a withholding tax. Let's say 30% of those proceeds are withheld by the US master fund and they're paid to the IRS, and $700,000 comes back to the Canadian investors on their individual our version of K1 is called the T5013. So individual investors, they take their T5013, they give it to their accountant. They said, hey, I put in 100 grand, I made $70,000, but 30,000 of it was withheld and paid to the IRS. Please recognize that and tax me on the difference amount because I've already paid taxes indirectly to the IRS.
Ah, wow, that's good. Good to know. And I think, yeah, I think it works something very similar with other investors from other countries as well, in terms of how the US fund deals with the foreign investor fund. Very cool. All right, let's talk about the real estate investing space, especially investing in syndications and in funds. Is it a big market there in Canada since it's harder to invest into other value add assets there? And so does that open up a lot more Canadian investors wanting to invest into the US?
No, of course, yeah. US real estate has a sexiness to it for Canadian investors who want to invest in the US. It really, the impetus was post GFC when the US dollar weakened and the real estate market went into a bust cycle. And there was a lot of Canadians coming down to, on the West Coast, going down to Arizona, on the East Coast, going out to Florida and Texas and buying property. Some of them on their credit card, they were buying properties. And that was the start for Canadians investing in the US. And then the syndication group started doing the same, allowing Canadians to have exposure to US real estate through the syndication model. But it's for in Canada, groups that are offering US real estate there are very there are very few handful of groups that are offering that. CPI Capital, our firm is one of them, and other groups that exist. But usually, most people, if they want to have exposure to U.S. real estate, they do it through public REITs. So that's how they do it. And the yields for public REITs are much lower than the yields that are
Right.
available in syndication. So public REITs are yielding something between 7 and 9%, whereas syndications could be something 15 and 20% per annum if the market is doing well. So yeah, when it comes to offering these investments for Canadian investors, these alternative investments as they're known in the syndicated format, they're very intimate as well, right? When you're investing in a public REIT, you're just another number, whereas in a syndication is very intimate. You're talking to the executive team. They're providing you with their business plan, and you're very much involved in it, even as a passive investor, because it's a smaller firm, in most cases a boutique, and you can see their growth and be involved and build something great kind of jointly with the managers of the fund.
Excellent. Okay. And I know you're pretty big into educating investors. Share with us a little bit about your platform, like your business model. How do you attract investors, what you educate them on, and things like that. So give us an overview on that.
Yeah, absolutely. So our platform, CPA Capital, initially when the company was founded, the vision was to allow Canadian investors to have exposure to U.S. multifamily value add. We were somewhat agnostic. We just wanted to be able to invest in the U.S. and then allow Canadian and retail investors to have access. And the reason we went with multifamily is because it had done so well over the last 20 years. This stat is a couple of years old, so it might not be accurate anymore. But at that time, multifamily had been one of the best performing asset classes in
Yep.
commercial real estate. Only industrial had beaten multifamily, and it also had beaten S&P 500 over that last trailing 20 years. So we felt multifamily is a great asset class. 100 million Americans are in the rental pool. They rent. Many of them live in apartments. So we felt that number continues to be growing as home ownership costs are increasing and its affordability concerns there. So we felt that it was a great asset class to be involved. So that was our initial focus. Currently today we focus on multifamily value add and build to rent, which I can touch on later. But initially we didn't have the infrastructure to be able to not only deal with investors and cross-border tax compliance and regulatory framework, because now we had to adhere by the Canadian regulatory framework and US SEC. So it was a lot of work to do for a newer firm with just a couple of partners, and we didn't have the infrastructure for acquisitions and asset management. So the decision we made to gain some track record was to partner with other groups who had the track record, who had the background. So we did the same model. We put together a Canadian feeder fund, and we invested into the US master fund, into the US syndication, and we brought a bunch of money into different deals into the US. We learned lots from that process. We learned lots because obviously there was some difficulties. We started a firm in 2019, 2020, COVID hit, and it was very difficult to get deals because you need to have $500,000 non-refundable day one. It was a bull market. Interest rates were very low. It was difficult. And then after that, the inflation started going through the roof and the Fed had to increase rates. I believe it was 11 consecutive times and a pause and a couple more
Yep.
times. So it was the fastest growth in history. So a couple of those deals went into distressed territory. Thankfully, we were able to salvage some of those deals with our partners that we had. So investors didn't lose any money, but it was very difficult. And we learned lots. A lot of times in those difficult times, you learn lots. And it allowed us to build our own infrastructure in-house for acquisitions and asset management, brought in a couple more partners to head those divisions. And we went on our own trying to close on deals. And we've closed on a few deals since that time. We closed on a deal, Atlas at Bay Point in Tampa. And it's been a great deal, value add multifamily deal, 136 units. And we always believed in US real estate, but we also noticed this asset class, which is built to rent. And built to rent, quick background about built to rent, post GFC, when the mortgage crisis happened in the US, subprime mortgage crisis, it resulted in home values dropping by 40%. Now, since the 1940s till 2008, home prices had never dropped in the US, had gone up an average of 4% per year. Wall Street knew that this is just a market cycle and the market will come back. So they made a gamble on single family homes and they bought tens of thousands of single family homes. Blackstone
Mm-hmm.
was one of those firms who came in They brought tens of thousands of single family homes. And the business model was very simple. It was just hold, and when the market turned, sell these homes when the market came back. But while they bought these homes, they started actually managing them, and they're renting them and managing them, and they start behaving lots like multifamily. There's more complexity when it comes to communities and portfolios of single family homes, particularly scattered ones. But the model did really well, tremendously well for Blackstone. And they started a company called Invitation Homes, took it public and sold it. But that was a start for build to rent. So in approximately 2013, 2014, when you couldn't buy homes and pennies on a dollar anymore and the market had turned, Wall Street still loved this asset class. So they actually started partnering with local developers and building communities of purpose-built rentals that was a spawn of build to rent. So we've been keeping a close eye on this asset class, and just similarly to multifamily, build to rent, it can also be structured in a similar way. So you can get partnered with a local developer and actually build a community of single family homes for purposes of either stabilizing and refining, holding it long term, or stabilizing it and selling it to an institution. You can purchase these days even communities of single family homes that are value add, where you can go in and create some value. We partnered with a local developer in Texas, and we bought a piece of land, building 30 duplexes. Now, the model is a bit different. So we're raising equity to fund the construction and development of these projects, but the exit plan is to sell these duplexes to individual cash flow buyers who are looking for cash flow to buy these duplexes, and they're cash flowing great. We're doing a rate buy down, so they're cash flowing close to $1,000 while they're also building equity in the background. So that's what we've done to date. So yeah, that's a bit about CPI and our business model.
That's very cool. Yeah. There's actually, yeah, a few firms that do that similar model of building duplexes to fourplexes and just sell it to the individual investors. And I know some of those firms, they create an HOA so that way they can manage the subdivision better long term. It's more consistent and they can control that the quality of the tenants better and things too. Are you guys planning to stay that active, or are you just gonna sell the duplex and be out of it?
We are. For the model for the Apollo Oaks deal is to sell these to individual. The marketing has already started for that process, and our developer partners has a huge database of 80,000 investors who are looking for these cash flow properties turnkey, because they also have a property management firm. So it's turnkey. They just buy it,
Okay.
very low down payment, is cash flowing day one. The model for this deal is definitely a build to sell model. But personally, I would love to own a build to rent property personally. My own funds, maybe partner with few close partners and build one of these and hold it long term just for that cash flow and equity building in the background. But yeah, probably we were really opportunistic to see what makes sense. Currently, DR Horton, which is one of the largest home builders in the US, they
Hmm.
have a few deals that they have built and they have also stabilized. So they're selling it tenanted, and the
Oh,
prices,
interesting.
yeah, their prices are really great. We looked at one in San Antonio, which was sold to a 1031 buyer, exchange buyer, and they bought it cash. So took a stab at it, but we were not successful. But yeah, we were noticing that DR Horton, historically, they have done these where they're merchant builders. So they build to sell to a end buyer who wants to buy a home, but they have not been involved to increase the velocity of their exit. So what they do, they actually do forward purchase contracts to an investment team like us. So like, okay, so we're gonna go under contract today, and you put a deposit, but you'll only complete on your purchase at the certificate of occupancy in tranches as homes get ready. So that's the standard model they've been using for the last few years. But this model to stabilize and actually tenant out the property is something that we've never seen. But recently we've got a few of those deals coming into our inbox. So it's interesting how a merchant home builder is getting involved in that aspect as well.
Yeah, that is interesting. I didn't know that they started in that. I have a piece of land that I'm working on developing, and DR Horton is half a mile from me. We're very near, like we're walking distance from each other, obviously. And yeah, they're putting in theirs is a 200 acres. They're putting in, I think, around 400 or 500 homes, and they're planning to just resell them. And I am 30 acres. And I actually opened up the conversation with them. Hey, you would be interested in selling lots to you. And And so yeah, we've been in conversations back and forth, but I didn't know they got into the build to rent
Yeah.
business. That's
Where is
pretty
your
cool.
land? What market is it? What
It's
state is
it's
it?
in it's in Houston,
Houston.
Texas. Yeah, Houston. It's a little bit northeast of Houston. There's a county called Liberty County, and there's a lot of growth that's happening on that side. And yeah, so anyways, I've been having some fun challenges with D.L. Horton. Yeah, so I'll share with you guys the story. Crazy story. I can't believe they got this approved from the city or the county, but both their land and my land sits on the same side of the street, and we have road frontage on two streets. The main street we get road frontage on is called FM 1960, which is fairly a major highway. And then behind us is a County Road 605. And where we are at, we don't have sewer. The sewer is like 2.3 miles toward downtown of the city called Dayton. And D.R. Horton was supposed to put in the sewer line on FM 1960 so that way all of the properties on FM 1960 can participate in that. And yeah, but then somehow they get approved for a private sewer line. Not even public, but a private sewer line on County Road 605. So they're the only one that have access to sewer. And yeah, so that like me and a bunch of other developers, like now we're having to figure out ways to team up with each other and bring down the sewer line on the major street side of the thing. But it's been a interesting back and forth with D.R. Horton and the city and as to what happened there. But fun stories when you do development.
Absolutely. Absolutely. When you build that many homes, I guess you got a push with the county and the government in some ways.
Yeah, exactly. I'm pretty sure. I'm pretty sure. It's very cool. So you how share with us a bit about how do you attract investors into your platform and start educating them?
Yeah, no, absolutely. Again, when we first started out, our focus was Canadian investors because we felt
Right.
that we had a bit of a monopoly there for Canadian investors to be able to invest with us and invest into these US projects. But soon we realized this by looking at other firms, Canadian firms who had started out and had availability for US products, Canadian firms that were focused on US real estate. And we realized that when they went the route of partnering also with US investors, that's really when they went hyperbolic. That was their really growth phase. So we knew that we didn't want to only have ourselves focus be limited to Canadian investors. We also wanted to bring on US investors. So our actually the spawn of the name CPI, our company was Canadian Passive Investing. But
Mm.
when we realized that we want to also partner with US investors, so we made the company's name change to CPI Capital. So our legal Canadian parent company's name is still Canadian Passive Real Estate Investing Inc. We wanted to have access to both of these markets. We wanted to be specialists when it came to Canadian investors. We also wanted to allow U.S. investors to participate. So simply the way that works, the U.S. investors invest directly into the U.S. master fund. Canadian investors invest into the Canadian feeder fund, and the Canadian feeder fund invests into the U.S. master fund. But initially, the pitch was pretty simple. It was for Canadian investors. Here's your chance to get access to US investors. We didn't think about this idea that Canadian investors are very hyper cautious, unlike their American counterparts. They're hyper cautious in a sense of that's what happens when it's cold out there. You need to plan for the future. If you don't plan ahead, you might freeze to death if you don't have enough food. So that's a joke I make about Canadian investors. So it's a lot harder raising money from Canadian investors than it is from
Mm.
US investors. And our joke is our investor relations team gets on a call with the Canadian investors. They're on call for days, for hours and hours, and the Canadian investors, okay, I'll think about it. I'll get back to you guys. Whereas a US investor is more like, what's your minimum? 50, put me down for 100. So that's the internal joke that we use inside here at CPI. But no, joking aside, Canadian investors are much more harder to raise money from. So we
Mm.
really made our bones learning to partner with Canadian investors, but we also made it more available. But the most important part, the difficulty that we had was track record. Is initially, how are you going to start this platform? How are you going to bring this? It doesn't matter how great it is. How are you going to bring these opportunities if you've never done it before? And myself, as a
Mhm.
home builder for close to a decade, I would never hire a roofer who's never built a roof before, right? If you doesn't matter how great your skills are and your background, if you've never built a roof before, why should I trust you? So that was a difficult hurdle to come over, and we achieved that by partnering with other groups who had a long track record, which was very helpful. But when you're speaking to more sophisticated investors, they want to see you having done a deal. They can see right away that this is a co-GP partnership. So if I'm giving my money to you and I'm investing in your feeder fund, I want to make sure you have the experience. So we realized that early on. So we knew that the co-GP model, the fund of funds model, was a stepping stone to get to final goal that we had, which was being the lead sponsor and the operator of the deal. Going back to gaining track record, another way to also to achieve that is by building a brand around yourself. And when you looked in my background and you Googled my name, everything was associated with single family home building. There was nothing about multifamily or syndications or real estate private equity. So for me and other partners, Ava Benesaki, who's going to present tonight, I believe, to you guys, and my other partner, Paul, it was important to build a brand not only around CPI Capital itself, but also around each of us individually. And we try to achieve that by different ways. Obviously, LinkedIn is a great platform because the LinkedIn algorithms are so powerful that if somebody Googles your name, as long as your name is not a generic name, LinkedIn is the first thing that pops up on Google.
Yeah.
So building a great LinkedIn profile is an important aspect of it. And really immersion. Immersion is another concept that I advise a lot to everyone, is being involved as much as you can. If it's joining a mastermind, if it's gaining a lot of knowledge in the space, if you have the opportunity to add value in any way possible, if it's writing a newsletter, if it's writing a LinkedIn newsletter, if it's doing posts on LinkedIn or social media, if you've gained enough experience, if it's jumping on podcast and other shows, if it's in any way possible. And we've done this multi-prong approach where try to get as much exposure as possible for CPI and for us. So we did that, and COVID had helped as well because everything was remote. So we were able to build a company remotely, started our own podcast. Great thing about starting a podcast is not only the content you're creating is evergreen, it's also great in the sense that you can also do podcast swaps. So if somebody comes on your podcast, you can jump on their podcast as well, which is really helpful initially when you don't have a huge audience or following or a lot of experience. Another great part of having your own podcast is also on the educational side. 5 years ago, 6 years ago, I thought I knew everything there is about real estate. But every time we have a new guest on, I realize how much I don't know about real estate and learning so much because in that hour that you're sitting with your guest, you're learning so much and consuming so much
Yeah.
information. But then the prior hour, when you're prepping for your guests and watching a couple of shows they've been on, you're also getting more information that's already been booked. So you can't run away from your homework. It's already booked. It's already in place. You don't want to cancel on your guests. So it's a great way to learn knowledge as well. And interesting enough, this might happen a lesser percentage of some of your guests that come onto your podcast could possibly invest. And we had that. We had that with a larger family office investment group that came on our podcast. This was a $300 million family office. And they were on our podcast, and I made a joke on the podcast for this person to provide us with some mentoring. I said, hey, I heard you mentor, and I want to ask you on the live podcast, would you be open to mentoring us? And he's like, yeah, absolutely, I will. So on that call that I booked in for the mentoring, this person actually thought that I was pitching them to invest in one of our deals, which wasn't at all. That wasn't my intention at all. But I'm like, since we're on the subject, what are you thinking about putting a little bit of money into our deal? So they actually ended up investing with
That
us
is
in our
cool.
deal. So sometimes a lot of things happen. Yeah, just quickly summarizing. So immersion is a very important part. LinkedIn is huge, very helpful. Very small percentage of people on LinkedIn regularly post. So get your LinkedIn profile up there and be active on LinkedIn. Creating your own podcast. An average lifespan of a podcast is 42 episodes. So consistency is key, and that creates
Yeah.
a lot of trust for investors and partners as well. So building a podcast and keep it going. Our podcast has been going on for 5 years now, over 250 guests. So it's been a great learning for us, particularly when it comes to after building that foundational, the proof that exists that you even exist out there, that you are an authority in some way, that you know what you're doing. When you have built that, and we can get into more of that in a moment, but after you've built that, then it becomes a process of how are you going to connect with investors. One of the very common ways people use to connect with investors is through paid ads. Paid ads have become very common. So I click on a lot of these paid ads when it comes to investment firms, be it Canadian or US. So the algorithms have picked me up. So they always send a lot of them in front of me. But just because you've spent a bunch of money on paid ad and you've got this lead and you've got a great infrastructure, your appointment setters and your closers and all the information you have for these people that might come in from paid ads, still the person needs to see some social proof. So if you have ABC Capital, but there's no information on ABC Capital online or on the principals, that process of being able to sell to them is going to be much harder. Or if you don't have a nurture process, some people might not be ready to invest with you right away. So those paid ad leads that you've created, they're not all for loss. You can keep them on your nurture process and send them your weekly or monthly email, letting them know that you're an authority in your space. It's not only about the strategies that exist to connect with investors, is also the infrastructure needed to nurture those leads and close those leads that come in. You also have to have deals as well. From post around 2022, approximately early 2022, it didn't make sense for us to do any deals. So we sat on the sideline for 28 months. So we never turned off the capital raising machine. So we're still getting on calls with investors. We're still nurturing our investors, sending our weekly email, which goes on at 6 a.m. PST every Sunday. We kept doing that. So when we finally had a deal after that 28-month hiatus, we were able to raise $10.5 million in less than 60 days. So it really helped. Yeah, I can get into different approaches that CPI utilizes to connect with investors, but just wanted to give that quick background.
That's really good. And yeah, I agree with you about the podcast and that consistency, which is one of the reasons why I like to do mine live, is because it forced me to show up. I don't have any, I can't back out. So it doesn't matter. I've been through two COVID. Yeah, I had COVID and I had to take a nap before I get on for the interview, and then go take a nap again after the interview. And so I get that. And that's just applicable to any type of marketing that you're going to be doing out there. Whatever marketing that you choose to take on, make sure you are consistent with that. And your investors get used to seeing you, and they come to expect that as well. It's almost like you're training them to expect your consistency to show up. Very good. Any cool tools that you use in your business? I know with AI these days, yeah, any cool tools?
Yeah, all of them. Just to go over the main ones that we use here internally as CPI, we use Slack for all communications. So sometimes you get excited or something important that comes up, you want to jump on WhatsApp or text message or send an email. We keep all internal communications on Slack. We also have multiple Slack channels. So when it comes to our legal team, our US legal team, we have a Slack channel dedicated to US legal team. All communications are done on that Slack channel. Canadian legal team, all communications are done on that channel. So we try to bring in our service providers onto Slack and have all our communications there instead of hundreds of thousands of emails going back and forth. So that's one tool that we use. All communications CPI happens on Slack. For project management, we use Asana. So Asana is a great tool when it comes to project management. That's task management, project management. We create different projects within Asana and manage those projects and the tasks associated with them. You can have external individuals joining or internal individuals joining. A quick hack on Asana: if you have Asana, the paid version, which is a great version to have, it limits you on the number of seats that you have. So if you go over 5 or over 10 seats, you have to pay that extra level of payment. But that's only if you use your company email address for the team members. So everybody has a cpi.ca at cpi.ca email, all the team members. So if you're inviting people to Asana from your own team, if you use their personal email, like a Gmail email, then it doesn't trigger and use up your seats. So that's a good hack to use on Asana. And if you don't want to go over too many limits, because everybody can have the same functionality, is just try not to use the company email. So Asana for project management, task management, Slack for all communications. We use HubSpot as our CRM. So we try to use HubSpot for all the functionality it provides. So aside from being a CRM where you keep detailed notes on your investors, we also use it as our main email composing platform. We also so all of our emails go out through HubSpot. They get designed and built on HubSpot. Even though we've been using it for 6 years, there are some complexities when it comes to building emails. So there are external contractors we use sometimes to create certain emails, the format or the style. So they're very much available on a lot of these Fiverr and on Upwork, people who are experts on HubSpot emails. So we use some external contractors if need be. And we also use HubSpot for forms. So a lot of times people create these web forms with WordPress or other platforms. We create all of our forms on HubSpot. An example of our form is, for example, what is an accredited investor? It's on our website. We use it other places in our social media posts. When you click on that, is actually a HubSpot form that pops up that's created to explain what a accredited investor is. Or when we have a live deal, we actually create the live deal, the deal room as we call it, that has all the information about the deal on HubSpot. So we use HubSpot not only for our CRM, but also for creating emails and creating all our forms. Other tools, obviously, AI, our VP of Investments, Paul Hopkins, has utilized ChatGPT and other AI platforms to create his own back of the envelope underwriting process, where he has provided ChatGPT and other AI to work in a way collectively where all the information comes in, and the information is really upload the CoStar report, upload the broker's offering memorandum onto AI, and then AI spits out all the information that it has previously asked it to provide. So it allows for a quick underwriting of a deal if it makes sense for us to get involved. And the way we measure that is really between the bid-ask spread. So if the whisper price is, for example, $10 million on a deal, and our back of the envelope price is coming at 30% below that, the bid-ask spread is 30%, and it doesn't really make sense. We want to be somewhere close to 20% or less when it comes to the bid-ask spread between what we're willing to pay and what the whisper price is. So to be able to underwrite as many deals as possible, as quick as possible, allows for us to have more deal flow. Aside from that, G Suite, obviously we use Google for lots of other internal items. Zoom is for all our meetings. But yeah, those are just some of the main ones that we utilize.
I love it. I love how you're able to just, say it off very quickly, very easily.
Yeah, I'm a guest where you don't have to put me on 1.5x or 2x. You just have to listen to me on a regular sound.
Right. I love that. We're going to open up for Q&A from the audience here. Before we do that, though, for those that want to reach out to you, learn more from you, and potentially invest with you, where would you like to send them?
Yeah, of course, LinkedIn. I'm very active on LinkedIn. I'm a LinkedIn top voice without bragging about it. But a LinkedIn top voice is an invitation only, where LinkedIn finds somebody interesting enough to give them an invitation. A lot of top CEOs around the world, heads of state, are top voices. So I'm a LinkedIn top voice. Connect with me on there. Don't just press follow. Actually press the 3 buttons and actually press connect, so you become my actual connection rather than just a follower. So connect with me. Send me a message. Love to connect. Get on a call and chat about what you're working on. As far as investing, obviously, every fund manager, syndicator loves investors, but it's more than that. I'm more about building relationships. So if you're a fund manager, if you're working on a deal and want extra brain power, if you want to just connect, more than happy to get on a call. So please, find me on LinkedIn or cpicapital.com, our website. Lots of great information there as well. So connect with me anytime.
Very good. And just so you know, I went on Google and searched your name, and your company website went above the LinkedIn one, which is good, right? That's excellent. Good SEO work on your team's job there.